Good evening, friends. With the sensex at 25K, the markets seem to be at the crossroads. Investors are keen to know now. In investing, there isn't too much one can do by looking at the rearview mirror. Yet, that is exactly what most investors always love to do. If only is the most common thought line. Here are a few questions that investors are grappling with. Why did I not invest in the stock markets before elections? Now, this question is on the minds of the majority. Have I invested enough at least now? Is it too good an opportunity to miss? Should I invest everything before the budget? Broadly, these are the four pins, and those were the bull tops. People accustomed to buying, but not accustomed to buying in a disciplined way, have this question on top of their minds. When the index moves, these investors start moving. Otherwise, they are mostly dormant. Now let us look at the bear thoughts. So what are the bears thinking? First, we need to find the bears in this market, and that is an important pointer. Everybody seems to be on one side of the market. There are hardly any bears left now. So that takes us back to those four bull questions that I just spoke about. And now I'm going to address those four questions because the answers to what we should be doing now lie in these four questions. Why did I not invest in the stock market before the elections? Have I invested enough at least now? Is it too good an opportunity to miss? Should I invest everything before the budget? The first one. Why did I not invest before the elections? Behavior, friends, is at the core of all investment success. The investor must keep refining his investment behavior if he is to succeed in his craft. Waiting to invest exactly at the right time is the most heightened form of speculation. By trying to time very finely, investors tend to pass over opportunity that is right in front of them. When valuations are attractive, investors wait, hoping that it will get even cheaper. While there is little doubt that greed is at the root of such behavior, the actual action falls clearly in the domain of speculation. Let us look at what investors have been doing in the run-up to elections. Most investors stayed out of the markets. Those who did participate in the equity markets seem to have sold and exited. Few investors showed the conviction in equity consistently during this phase. Once the results were out, the markets just flew away. A few investors have jumped in on results day. After results day, others have been entering markets as the markets kept rising during the subsequent fortnight. Clearly, I believe that the actions undertaken after the results were out are more reactive and therefore speculative. Even if you put money saying that, oh, the results are behind us and you're rushing in, that investing to me does not qualify as genuine long-term investing, and it's more reactive in nature. These actions, therefore, fail to qualify as being investments in the strict sense of the term. They are hurried, reactive, and short-term oriented, and therefore I would not choose to call such actions as investments. If markets correct sharply, as they seem to be threatening now, these investors who have jumped in will be found extremely short of conviction to buy. So the question in your mind should be, have I invested enough at least now? And that you need to address progressively. Here again, rushing to a situation could hurt you. When there is an imbalanced equity allocation, it should be gradually corrected. What do I mean by this? Most people have investment portfolios which has a house, gold, real estate, cash and equity, and the allocation to equity is definitely out of sync, very small in comparison to allocation to the other asset classes. Now, this needs to be corrected if somebody is going to play on an economic turnaround in India and the return of growth. But that play has also got to be done in a manner which is more disciplined and orderly. I would think that a measured investment approach is what is needed now. What do I mean by measured? By measure, I mean that the investing should return to being driven simply by valuations. That you missed investing before the elections should hardly matter now. That is something that you need to forget about. I mean, what you failed to do or did before the elections is now history. If you have invested well, fine. If you have not invested also, that is not something that should overly bother you. You need to achieve investing to the future. And the trading rally post-election is done and dusted, in my opinion. It's time to think of what needs done over a much longer time horizon. Choices must be made with a long-term term in perspective. A gradual increase in equity exposure is what we advocate at this point in time. Is it too good an opportunity to miss? Frankly, the economic reality looks gloomy. It's quite gloomy. But the government has a mandate to take up decisions. We see this as a unique opportunity to correct the ills of our economy. We will see reform return with a bang in the budget. Some signals would be the implementation of GST, speeding up of decision making in government, emphasis on global trade at the topmost level, battling of inflation. These are all factors that will be huge positives. Clearly, investment opportunities are looking better. Prospects of businesses, therefore, will steadily improve investors. And therefore, this is an investment opportunity that is definitely too good to miss. Should I invest everything before the budget? While the opportunity is too good to miss, one should still invest gradually. A close watch should be kept on developments in India and in the global. One should always have in cash to invest the budget. The budget will only set the country on a certain economic course, but global trends will influence and prevail once the budget sentiments are completely developed. Therefore, a balanced approach is what is needed, and a concerted investment plan that is continuous is what one should look at from now. Investing all the money before an event is not a good idea. Investing more money should be a function of a fall in valuations. If stock prices crash or fall, we can make more investments. That would be a great time to scale up your investing. So what are the few remaining bears thinking? Let's look at the negative side. We need a balanced view. There are few positives. There are very few positives that have not been factored in these markets. Valuations are nearly fair. I think companies and businesses are all trading very close to fair value. They're not cheap anymore. Immediate upside can only come from a valuation expansion. That is because others are willing to pay a higher value for same assets. Now, that is something that I would, as a value investor, not make the basic premise of my investing. Because essentially, if others are willing to pay more and more for assets that you own. That can happen only when the market risk goes up, and I'm not praying for that right now. So one should overlook the immediate upside which can come from valuation expansion. Importantly, earnings expansion, that is the earnings, the EPS of companies growing, can take some more time. It's not going to happen immediately. So the government's measures and initiatives will all kick in, and the benefits will flow or begin to accrue after a lag of a few quarters. It means this financial year we may not see too much of improvement in earnings. The monsoon may play spoil sport. Now this is a real threat, and one can see that already the monsoon's behavior has been quite erratic, and it's still early days, and we could see some damage to the agri GDP from the monsoons. Most importantly, the worst managed companies have shown best price gains in the stock market, and that is something that is a pointer to the quality of this rally. You have seen stocks in real estate, Suzlon Energy gained the most, which is a pointer that post-election has been largely speculative and less investment oriented. So what should be a balanced view? Valuations today are closer to fair. 4 months ago, they were closer to peak. That's why we were aggressively investing in the beginning of the year. Monsoon definitely slowed the return of growth. So that is the worry that remains, and it is something that we have to live with. Inflation will remain high. This is another area where no immediate solutions, because if food production is affected, the government will be firefighting right through the year. While this government may be able to firefight effectively, it may not be able to bring inflation down significantly. Earnings expansion can come only from cost gains, but that again is something that is threatened because of that we are seeing in Iraq. If it lasts for too long, then you could see earnings expansion getting affected from the third quarter onwards, because oil pricing high will affect corporate profits. It's still too early to sell and go away. What do I mean by this? See, while you are sitting on gains, what I think from an investment perspective makes a lot of sense is to consolidate your investments during this phase and not look to be a trader. So if it remains soft for the next 9-10 months, or it gradually softens, one should look to invest aggressively as the market softens, because one must be playing for a much longer time horizon. There is, and that is my next point, very good upside from a 3-year perspective. So why should you take your profit away now? When you know that for the next 3 years, you will earn progressively much higher sum of money. Reforms will constantly create undervaluation. This is something that you need to understand. One simple example is that if there is an gas pricing, you will see much more gas production, investments in gas space. So that will create a lot of gas production. When it creates a lot of gas production country, you will see benefits accrue to so many people, those in gas transportation, those who are into retailing of gas, who power from gas, the power plants will see higher utilization, and you will see the trickle-down effect when reforms really deliver. Similarly, when you have more domestic availability of coal, you will see the trickle-down effect. In many cases, you will see those who supply to mining companies, consumables to mining companies benefit. You will see mining gain more activity and traction. You will see transportation needs increase for mined coal. You will also see that more coal is available for merchant power producers. You will see a drop in merchant power prices. You will see that there will be better production of energy, and therefore less shortage of power, translating to better industrial productivity and social productivity. So reforms will certainly create undervaluation, and the markets will keep on adjusting. So looking at today's peak for a 3-year view may look quite silly. So one should gradually keep a watch on these events and how reforms are playing out and where the undervaluation is happening, and improve one's exposure to equity in those buying should be clearly bottom up and valuation driven. So you should buy businesses based on the value or sectors based on the value rather than looking at the index of 25,000 or whatever number you may see. So what should be the strategy? Take stock of your equity exposure. How much do you own as a total percentage of your wealth? So that is something that everybody should look at now. If it is low single digit, then you need to correct that. And I would think somebody in his 30s, 40s or even 50s can look at an equity exposure somewhere between 25 and 40%. It should be somewhere in the region according to your risk appetite. Lower than that means that you are definitely exposing yourself less to equity than you should. Those who have higher exposure than 40% are probably the younger people or those who have a better risk appetite. So you should ensure that your wealth allocation is balanced. You can't have little or no equity and everything in real estate and gold. So you need to rebalance your wealth allocation, and this is the time to do that. Now let us look at a typically balanced allocation. This is a typical balanced allocation that I am advocating, where you have a real estate exposure of 50% because at these real estate prices it can't be lower than that. Look at an equity allocation of at least 30%. Your cash and gold at least 20%. Now this is what I would think is a typical balanced allocation for anyone who wants to have a more measured approach to wealth allocation. But most allocations look like this, where you look at this chart, real estate is 80%, equity will be 5%, and gold and cash is 15%. Now in cash, you can also include your fixed deposits in that gold and cash quadrant. So here you find that people have very little liquidity in their wealth creation, and if real estate comes, then you will see that their overall wealth pie will shrink. Now that is a risk that people should not take at this point in time, and over the next 3 years, by expanding your equity allocation to something like the last slide showed you to 30%, when equity grows, it will ensure that your wealth pie expands. Now, if you see the other chart, if real estate shrinks, your wealth, it will take your wealth pie also shrinking with it. And this is a risk that you need to address now and rebalance your asset allocation. Asset allocation changes again should be in a phased manner and not drastic. You should not take big money and put it in one day equity. 3 words are very important when you change your asset allocation: gradual and systematic. That is how you use your asset allocation to a more progressively equity driven one, because it has been very heavily real estate driven during the last decade. So there is a need to give better opportunity to the economy to make you richer. Set a goal for 12 to 24 months depending on your financial position. I personally believe that the next is really the investment phase in equity, and by the time the phase comes to an end, you will see delivery go up. So that is something that is sure to happen, and you need to get yourself ready for that. So getting your allocation right is even more important now, especially with the churn asset performance that we expect. And investors must understand that asset classes that have done well in the future and asset classes done badly in the past may well be the ones that will perform going forward. Friends, with that, I am coming to the end of this presentation part of it. I am giving